Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. Today once more I want us to solve a question, financial accounting CPA 1, May 2021 question 4. May 2021 question 4. Once again, my name is Muchai, your tutor in financial accounting made simple. And I would want you to support us by subscribing. Please subscribe, like, share, and hit the notification bell so that every time we are uploading this beautiful, good new videos, we can always inform you. The question reads, the following trial balance was extracted from the books of accounts of Almod Limited as at 30th of September 2020. You have ordinary share capital at par value of 10, 20,000, 8% redeemable preference shares, 12,000, 6% debenture, 10,000, revaluation reserve, 3,400. Everything is in thousands. Retained earnings at the beginning of the year, 14,160, sales, 283,460. Inventory, opening inventory, 12,400. Purchases on 47,200, distribution cost 22,300, admin expenses, interest on debentures. I always say, anytime you find debentures, always the first thing is compute the debenture interest incurred, because usually what is incurred is more than what was paid. So that what is incurred, you deduct in the income statement, and what has not been paid, you record it as a liability in the balance sheet. Interim dividend paid, ordinary and preference, investment income, buildings, plant and machine. As you read your question, already you should be formatting your answer in your mind. You can see this question has investment income, and therefore you have other incomes called investment incomes, buildings, plant and equipment, furniture and fittings, investments. Your investments, 34,500. Then accumulated depreciation for building, plant and machinery, furniture and fittings, accounts receivable, bank overdraft, accounts payable, deferred tax, suspense account. And then you have additional information. You are told, number one, the amounts in the suspense account was discovered as a result of 2,000 ordinary shares issued at shillings 13 per share. Number two, the annual stock take took place on 6th of October. It did not take place on 30th of September. It took place on 6th of October 2020, and therefore you need to adjust backwards. It gave an inventory value of 14,500. During the period from 1st of October 2020, the following transactions took place. Almod Limited makes a uniform rate of gross profit of 25% on selling price. As at 30th of September 2020, no entry had been made in the books for the following and presented checks. Stationery 160, payment in advance for goods worth 300,000 to be delivered in October 2020. That is a prepayment. The company received demand notice for rates of 240,000, meaning we have not recorded them, for the year ended 30th of September 2020. Number 5, the company's policy in relation to annual depreciation on its non-current asset is as follows. Plant and equipment have a residual plan value of 5,000. As of 30th September 2020, an allowance of 4% of accounts receivable is to be made, as well as provision for corporation tax of 18,500. As of 30th of September 2020, the investment portfolio was broken down as follows, so that you can take them, some to current assets and others to current liabilities. Short-term investment and long-term investment. The directors proposed to pay a final ordinary dividend of 10%. You are required to prepare the income statement and the statement of financial position. So you start doing your workings. May 2021 question 4. May 2021 question 4. And I want to repeat again that we are teaching online. If you want to join our classes, please, there is a number scrolling on the video. Kindly contact us using that number. We will advise you, we will guide you. We have done this for the last 16 solid years. And I can assure you, we remain the best in this country. Thank you very much. So we are told an amount in the suspense account was discovered as a result of 2,000 ordinary shares. We issued 2,000 ordinary shares, 2 million actually, ordinary shares, 2 million ordinary shares at 13 shillings, at shillings 13. You must always ask yourself, when we issue ordinary shares, are we issuing at par or are we issuing at beyond par or at a premium? Are we issuing at a premium? From our trial balance, we can see that our ordinary shares have 10 shillings per value, and therefore we are issuing at 3 shillings premium, at a premium of shillings, 3 shillings. And definitely what we are being told is that we debited bank. The reason the trial balance did not balance is because we debited the bank. When we were receiving the money, automatically the bank was debited, but we never credited ordinary share capital and share premium. So if we get to ordinary share, so ideally we would be debiting suspense account. We debit suspense account with 2 million times 13. 2 million times 13. 1, 2, 3 times 13, we get 26 million. So we debit suspense account with 26 million, and we credit ordinary share capital. With the 20 million. That is 2 million times 10. 2 million times 10, you get 20 million, and we credit share premium. With 6 million. That is 2 million times. We are told we are issuing it at 13 shillings, and the par value is 10. So we first of all credit ordinary share capital with 10 times 2 million, 20 million, and then the remaining 3 times 2 million, we get 6 million. And therefore, our suspense account from the TB, I told the suspense is a credit of 26,000. Balance per TB, it is 26 million. And here we are now debiting it with ordinary share capital 20 million, and share premium 6 million, giving us a total of 26. So the suspense account has a zero balance now. But we get our ordinary share capital account from the balance sheet. Ordinary share capital is 20,000. Balance brought down, it is 20,000, and you know it is shillings in thousands. So from suspense account, we are adding 10,000. So at the end of the year, we have 30,000. We have 30,000 as a balance for ordinary share capital. And then the share premium account, you check whether you have a balance at the beginning, and you can see we do not seem to have a balance. We do not seem to have a balance of share premium. So we come here and say ordinary suspense account, we have something from suspense account amounting to 6 million. Our share premium will go to the balance sheet as capital reserve, and the ordinary share capital will increase to 30,000, and by that we will have resolved the cost for the balance sheet not to balance. Then we are told number two, we told something very interesting. We are given something. We did we valued our inventory. We valued our inventory on 6th of October. Our year ends on 30th. Our year ends on 30th of September. 30th of September 2020. But we are valuing it on 6th of October 2020. And therefore, a lot of activities have taken place during this time. When we took the stock take around this time, the value of the stock was 14,500. 14,500. But during this time, we have sold some inventory and we have purchased some inventory. And therefore, whatever we have sold reduced our inventory, so we add back, and whatever we have added increased our inventory, so we subtract. Now we have been given purchases and purchases returns. We have been given sales and sales returns. So ideally, we are saying our net purchases is equal to purchases of 470 minus purchases returns of 80. Purchases return of 80 for 70 minus 80, we get 390. We get 390. Then we have net sales, which is sales minus returns, so that we can get the actual sales. Net sales is 1600 minus sales returns of 200. Sales return of 200 giving us 1,400 as our net sales. But we know that we sell at a profit. And we want to know the closing stock. And therefore, the inventory which we are selling at 1,400, this is at the selling price. We want to know the cost. So that we can work backward to get the value of inventory at the close of business. And therefore, we are told that the gross profit, the uniform rate of gross profit is 25% of the selling price. So we are told gross profit over sales is 25 out of 100. Gross profit over sales is 25 out of 100, and we are told our sales is 1,400. We are told our sales is 1,400, and therefore gross profit divided by 1,400 is equal to 25 divided by 100. So gross profit, which implies that gross profit for this particular sale, it is 25% of 1,400, which is equal to 0.25 of 1,400, which is 350. Now we are saying we made sales worth 1,400 and the gross profit is 350, and therefore 1,400 minus 350 will give us the cost of goods sold. Cost of goods sold is equal to sales minus gross profit. Is sales minus gross profit, and our sales is 1,400 and our gross profit is 350. Our gross profit is 350, and this gives us 1050. That gives us 1050. So the cost of the goods that we sold was 1050. Now we are told that the closing stock was 1,400, but we have increased whatever was here. We increased with what we purchased, and we reduced it with what we sold. So we reverse what we did. So we're saying closing stock as at 6th of October 2020, we are saying it is 14,500. It is 14,500. Now, we sold, so we reduced, so we add back. Add cost of sales, because that was reducing our inventory. You add 1050, but we added more, we purchased, which we increased our inventory. So because we increased we will now need to less the purchases. Less purchases. Less purchases. Purchases, we said it is 390. It is 390. It is 390. So we are saying, how did we come to 14,500? We came to 1,400 because what we had here at the beginning, we sold and therefore we reduced. And because we reduced our inventory, now we are adding it back. Now we also increased by purchases, and because we increased what we had, now we subtract. Whatever we had added, we subtract. Whatever we had reduced, we add back. And this will give us our closing inventory to be a figure of 14,500 minus 390 plus 1050 giving us a figure of 15,160. That becomes our closing inventory, 15,160. Our closing inventory, we compute our closing what? Our closing what?
Inventory.
Our closing inventory. Number 3. As of 30 September 2020, no entry had been made in the books for the following and presented checks. So we had not debited or credited 160,000. So we now record it. So we say bank, or bank account, balance brought down, and then stationary expenses. Stationary what?
Expenses.
Stationary expenses. Now, our bank balance from the trial balance, bank overdraft is 1680. It is an overdraft. Balance, it is 1680 overdraft. Meaning it's not on the debit side, it's on the credit side. It's not the debit side. And bank overdraft is bank paying more money than we had. And therefore we owe the bank 1680. You don't bring it to the debit side, you bring it to the credit side. You bring it to the credit what? Side. And therefore we record this stationery of 160, that we are increasing the expense of stationery 160, and we increase bank overdraft with 160, and we are saying stationery. We are saying it was not recorded in the bank account, now we recorded it, and it was not also recorded in the stationery account, therefore we recorded it. Then we have prepayments, payment in advance of goods worth 300,000 to be delivered in October. Payment in advance of goods worth 300,000 to be delivered in October, and therefore we need to debit bank. We need to credit bank with goods in the call it prepayment. We are making a prepayment for inventory of 300. We have a prepayment of inventory of 300, and therefore we say prepayment. Prepayment account of it. So it's an inventory prepayment account. It's an inventory prepayment account. We debit it with 300. We debit with 300, and it is coming from bank. It's coming from where? It's coming from bank. We have not recorded these transactions, but now we have recorded them. Number 4, the company received a demand notice of 240 rates for the year. So we are receiving a demand, meaning we have incurred, but we have not paid. So we have rates payable account, and we have rates expenses. We have rates what? We have rates what? Expenses. So for the rate payable, the rates payable is 240. So the liability is 240, and the expenses is 240. The expenses is 240. The expenses is to what? 240. Number 5, we given the basis of depreciation expense, and we are saying building 4% straight-line basis, building 4% straight line, plant and equipment, 15% straight line, furniture and fittings, it is 10% reducing balance basis. 10% reducing balance what? And something very interesting, we are told that plant and equipment has a residue. Plant and equipment has a residue of 5,000. That one you don't depreciate. You don't do what? You don't depreciate. So, building, original purchase cost of buildings is 56,250. 4% times 56,250. Plant and equipment 55,000. But we are told that there is something we are not depreciating amounting to 5,000. It's called scrap value. We are not depreciating the scrap value. We are not depreciating the what?
Scrap.
The scrap value. Because we are told there, please mark that one, We are told plant and equipment have a residue value of 5,000. If it is a residue value, you don't depreciate the residue value. Even if it's straight line, you depreciate the depreciable amount. The depreciable amount is 55,000 minus 5,000 scrap value. Minus 5,000 scrap value. The other one, that's an area where you could very easily make a mistake. The other one, we are told for the furniture and fittings, it is the reduced balance. We are depreciating the reduced balance. We are getting the net book value at the beginning of the year. That is the reduced balance. That is the original purchase cost minus the accumulated depreciation. And furniture and fittings, the purchase cost is at 5,000. And the accumulated depreciation at the beginning of the period, furniture and fitting is 9,600. 9,600. So we get those figures. We get those figures. And we are saying 4%, 0.04 of 56,250. 56,250. We get a figure of 2250. We get a figure of 2250. 55,000 minus 5 is 50,000. 50,123 times 0.15. We get a figure of 7,000. We get 7,500. We get 7,500 what? 500. This one is at the 5,000. 1, 2, 3 minus 9,600 times 0.5. 0.1. It is 2,540. It gives us 25 what? It gives us 2540. It gives us 2540. It gives us 2540. 2540. It gives us 2540. So the building is that, the plant and equipment is that, and furniture and fittings is that. Then we are told, number 6. As the 30th September 2020, an allowance of accounts receivable is to be made, or 4% is to be made, as well as a provision for corporation tax of 18.5. So allowance for doubtful debts. Allowance for what? For doubtful debt is being made at 4%. 4% of debtors. 4% of what? Debtors. And our debtors, accounts receivables, our accounts receivable is 35,700. 35,700, giving us a figure of 0.04 of 35,700. We get a figure of 1428. We get a figure of 1428. 14 what? 28. Then we are told that corporation tax, you must never forget when you are told that we are providing for tax. It means it is both an expense and a current liability. An expense and a current liability. An expense and a current liability, and therefore you must take it to the balance sheet as a current liability. So our corporation tax is 18,500. Our tax is 18,500. Our tax is 18,500. And then you are given there, number 7, the breakdown of the short-term and long-term investment. The total investment is broken down into long-term and short-term, so that the long-term can be taken to non-current assets and the short-term can be taken to current assets. Then you are told the directors propose, number 8, the directors propose to pay final ordinary dividend. You can see there is dividend being paid. And every time you find that there is dividend being paid and there is preference shares, you must ask yourself whether we have paid all the preference share dividends, because the rate is usually given. So preference dividends, we are told from the total balance it is 8%. 8%. You multiply by the capital, preference dividend capital, 12,000. 12,000, we get a figure of 0.08, 0.08 of 12,000. 1, 2, 3. We get a figure of 960. You get a figure of 960. You get a figure of 960. 960. And the question is, how much have we paid? Interim dividend preference. We have paid 480. Less paid. Less paid. We have paid 480. So unpaid is 960 minus 480 is 480. So the amount that is accrued that will be shown, we will show a preference dividend expense of 960 in the income statement, but we show a current liability. So the payable, we show a payable of 480. We show a payable of 480. And then we are told that final ordinary dividend of 10%. Final ordinary dividend of 10%. It means this 10% has not been paid. Irrespective of what has been paid, you can see they have paid ordinary dividends of 2,000, but we are told they are proposing to pay an extra 10%, a final ordinary dividend. The final, meaning there was an interim. The first one they paid, yes, but the final is 10%. So ordinary dividends, ordinary what? Ordinary what?
Dividends.
Dividend is 10% of the dividend, ordinary share capital, 20,000. 20,000, and therefore the dividend is 1,000. The dividend is 1 what? Now, this will mean our total dividends, ordinary dividend is 1,000 plus what has been paid. Our total ordinary dividends is the 1,000 unpaid plus the 2,000 paid. Our total preference dividend is 480 paid plus the 480 which is not paid. So in the income statement we capture the total, and in the balance sheet we only record what is not paid. So this is payable. This is what? This is payable. This is a liability. This is a liability. This is a liability. Those are the adjustments that you're supposed to do. Those are the adjustments that you're supposed to do to get that question correct. Those are the adjustments that you're supposed to do to get that question correct. So we now get the income statement. We now get the income statement, and we say Almond Limited income statement for the year ended for the year ended 30th September 2020. And we start with our sales. What is our sales? Our sales is 283,460. 283,460. Always carry the format in your head and ask yourself, what is the next step? The next, after sales, you always say less return inwards or sales returns. But we don't have sales return in the question. We don't have sales return in the question. So we say less cost of goods sold. 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 Once again, these questions are online. These questions are online. If you go online and you type CPA1 financial accounting, CASNEB CPA1 financial accounting past papers, you will get them. CPA1 financial accounting past papers, you will get them. Over and above what we are displaying as we start this question, I want to assure you that these papers are online. You can easily get them. Just go online and you say CPA1 financial accounting past papers, and you will get them. So less cost of goods sold. Our opening inventory Our opening inventory is 12,400. 12,400. We add purchases. We add what?
Purchases.
We add purchases, and our purchases are 147,200. 147,200. So we add the two. 12,400. 12,400 plus 147,200, we get a figure of 159,600. We get a figure of 159,600. These are cost of goods available for sale. I don't have space. Please don't write in short in your final exam. Always write in full. Cost of goods available for sale, and then you say less closing stock. Less closing stock. And we did a working of our closing stock here, 15,160. We did our working of our closing stock here, 15,160. 15,160. So we subtract 15,160 minus 54,440. We get a figure of 144,440. 440. And that becomes our cost of goods sold. Cost of goods sold. Write in full. Write in full. Write in full. Please don't write the way I'm doing in initials and then say in the final exam you're going to write in full. I want to assure you, what you train your mind to do, that's what it will do even in the final exam. So even if I do COGS, please ensure that you write in the full. Cost of goods sold is 144,440. If you subtract from the sales up there 283,460, 283,460, you get a figure of 139,020. 139,020. 139,020. 139,020. But we know we have investment income. We have investment income from the trial balance amounting to 1,500. So we add other incomes. We add other incomes. So this is gross profit. This is gross profit. And we are saying add other incomes. Add other what? Other incomes. We add other incomes, and our income starts with investment income. Investment income of 1,500. Our investment income of 1,500, giving us a figure of 1,500. You get a figure of 140,520. 140,520. 140,520. 140,520, and that is the aggregate income. That's the aggregate what? Income. So we'll say less expenses. We less what? Expenses. Now, remember what I told you. Anytime we are saying less expenses, there are two types of expenses to always deduct here. There are the expenses where you made adjustments, and there are the expenses where you go straight to the trial balance and you get them. So we come here to our workings. And we pick all the expenses which we had adjusted, and then we pick the expenses which we never had adjusted. Here we pick the ones we adjusted. Once we are through with everything we adjusted, then we go to the trial balance to pick the ones we never adjusted. Never forget that. Never, 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 never forget that. That we get expenses from two sources. We get expenses from two sources. One of them, the expenses from our workings. You start with them, not forget them, and then you go to trial balance to get the ones we never adjusted. So you come checking here. Original capital, pretty to purchases, cost of goods sold, closing stock, so bank, stationery expense. We capture it there. Stationery expense. We capture it at 160. Then we have inventory prepayment. We said is a current asset because it was not spent. It was not spent, so it's a current asset. Less payable is a current asset. The late expenses. Late expenses 240. Late expenses 240. Depreciation building 2250. Depreciation building 2250. Plant and equipment 7,500. Plant and equipment 7,500. Furniture and fittings 2,540. 2540. Allowance for doubtful debts. We told it is, at the end of the year, it is that amount. It is 1428. The question is, did we have allowance for doubtful debts in the course of the year? Did we have, at the beginning of the year, did we have allowance for doubtful debts? And the question does not seem to have any allowance for doubtful debts, and therefore we may need to capture it as it is, as allowance for doubtful debts. Allowance for doubtful debts, we capture it as 1428. Allowance for doubtful debts. 1428. 14 what?
28.
1428. Then we can have tax, we have preference dividend, we have ordinary dividends. Those are the expenses that were adjusted. Then go to the trial balance and get the second category of expenses. Go to the trial balance and get the second category of expenses, expenses which were not adjusted, but they are in the trial balance. They are where?
In the trial.
So we have distribution cost, 22,300. Distribution cost, 22,300. We have admin expenses, 34,440. Admin expenses, 34,440. 34,440. Interest on debenture. Have we captured debenture interest? Debenture interest. Debenture interest. We don't seem to have captured it somewhere. That is very, very important. That is very, very important. That is very, very important. And I want to capture it here. I want to do the workings for the debenture interest here. I want to capture the working for debenture interest there, because we are told that we have 6% debentures. 6% debentures. 6%, and the total debenture is 10,000. 6% total debenture is 10,000. 6%, the total value, total of interest expense, it is 6% of 10,000. 0.06 of 10, 1, 2, 3, 18, which is 600. It is 600. It is 600. But we have paid from the trial balance. We are told interest on debentures paid, so we less paid. This is debenture. This is debenture. Less paid 300. So 300 is payable. 300 is what? Payable. Debenture payable. This is debenture interest payable. Debenture interest payable. So the total expense for debenture interest is 600. So debenture interest 600. Debenture interest 6 what? I'm looking at the trial balance in the question, and I'm going down checking any expense which are not captured there. So debenture interest, interim dividend, investment, building, plant and machinery, investment income, accounts receivable, bank overdraft, accounts payable, deferred tax, a suspense. Nothing else. Let's try to add up and find out if they give us the correct figure. So let's try to add them up. 160 plus 240, 160 plus 240 plus 2250 plus 7500 plus 2540 plus 1428 plus 22300 plus 34440 plus 600. We get a figure of 71,458. That is total expenses, 71,458. Those are total what? Total what? Expenses. Total expenses. And therefore we get profit before tax. We get profit before tax. Before tax. We subtract the aggregate income to the total expenses to get the profit before tax. Minus 140,520, 140,520, we get a figure of 69,062. 69,062. That is our profit before tax. That is our profit before what? Tax. Before tax. But we are told here here we were told that our income tax is 18,500. We were told here that our income tax is 18,500. Our income tax is 18 what? 500. So we say less tax. We say less income tax expense. Less income tax expense of 18,500. 18,500. We get profit after tax. Profit after tax of 69,062 minus 18,500. We get profit after tax of 50,562. 50,562. We get 50,560 what? 2. This is profit after tax. From that, we subtract less dividends. Less what? Dividends. Less dividends. Please remember, we have had a video which gives us the format of the income statement and the balance sheet of our company. Please look at those formats. Memorize the formats, because whatever I'm doing, I'm getting it from what is in my mind. Memorize the format. So we say less dividend. And we know we had interim dividend and we had the final dividends. So we say interim dividend. And anytime you are listing the dividend, preference dividend always comes first. So you get preference dividend from the trial balance is 2,000. Ordinary is 480, giving us 2480. Giving us 24 what? So we then say final dividend. We say final dividend. See the order. Preference always is the first one. Preference and ordinary. Preference and what? Our preference dividend, we said it is the final one is 480. And the ordinary one, we said it is 1,000. And the ordinary, you see, the 1,000, you add all the dividends, and then you subtract. By the way, we are told this ordinary dividend, we needed to be extra careful there, because our ordinary share capital is moving from 20 to 30,000. Our ordinary share capital is moving from 20 to... by the way, look at this. Look at this. Yeah, here we missed something. Ordinary share capital is increasing with the 20. Our ordinary share capital is increasing with what? It is increasing with 20,000. Our ordinary share capital is increasing with 20,000 to 40,000. To what? It is increasing with the 20,000. So we credit as ordinary share capital with 20 as we debit suspense account with 20,000. So our ordinary dividend here now is multiplied by 40. Our ordinary dividend is multiplied by 40. So we get 10%, and our dividend payable is 4,000. Our dividend payable is what? 4,000. So we come here and we get it as 4,000. We get it as 4,000. We add everything now. All the dividend, we get 2480 plus 480 plus 4,000. We get 6960. We get 69 what? 60. We get 6960 as total dividend. So you subtract the profit after tax, you subtract all the dividend, minus 50,562. 50,562. We get a figure of 43,602. 43,602. That is the retained earnings for the year. That is the retained earnings for the what?
Yeah.
Retained earnings. That's the retained. That's what we are going to retain in the farm. Retained earnings. That's the retained earnings for the year. So we add retained earnings brought down. Add retained earnings brought down. And our retained earnings brought down from the trial balance, our retained earnings from the trial balance is 14,160. 14,160. 1, 2, 3, 4, 5. The fifth item, 14,160 from up there. 14,160. 14,160. 43,602. 43,602 plus 14,160. We get a figure of 57,762. We get a figure of 57,762. 57,762 is the retained earnings carried down. Is the retained earnings carried what? Carried down. That's the retained earnings that we take to the balance sheet. That's the retained earnings we take to the what?
Balance.
So if we can keep it here, because that's the only item we are going to take to the balance sheet, if we can keep it here, 57,762. 57,762. That is the retained earnings. That is the closing balance of the retained earnings, 57,762. That is what we're going to take to the balance sheet. That's what we're going to take to the what? To the balance sheet. And therefore, we now go to the balance sheet. I'll still erase this bit. So because we still have to use our workings. We still use our workings in the course of preparing our balance sheet. So let's delete this to get our balance sheet. So we can prepare our balance sheet or our statement. Our statement of financial what? Position. Our statement of financial position, so that we can find ourselves with all our marks. Remember the format. Almod Limited. Statement of financial position. Statement of financial what? Position as at 30th of September 2020. 30th of September 2020. Remember the format. We always start with the assets. Then from assets, we say non-current assets. Non-current what? Non-current assets. And then we say cost, provision for depreciation, and then here we say net book value. Now, remember that non-current assets are arranged in order of permanence. Non-current assets are arranged in order of permanence. And our first non-current asset, therefore, in order of permanent, is building. Our first non-current asset there is building, or 56,250. And we do not have, we are not given its depreciation, and therefore 56,250. Therefore, we are not depreciating it, 56,250. That's the first one. Then we come to plant and equipment. Plant and equipment, it is 55,000. 55,000. And we look at the depreciation at the beginning of the year. Plant and equipment, at the beginning of the year, it was 12,800. It was 12,800. 12,800. Then, at the beginning of the year, as listed in the balance sheet, listed in the trial balance, it is 12,800. Then we get to the workings for depreciation. We add the charge for the year. The charge for the year for buildings, the charge for the year for buildings here, it is 2250. It is 22 what? 2250. It's 2250. So we add 2250. We add 2250 to get the closing depreciation. Get the closing depreciation of plant and equipment. I repeat again, from the trial balance, the plant and equipment is 12,800. 12,800. We add the charge for the year. We charge for the year. We get the charge for the year of which is 2250. 2250. We get a figure of 15,050. Get a figure of, from the trial balance, plant and equipment, the balance is 12,800. 12,800. Then we get the charge for the year. Plant and equipment, the charge for the year is 7,500. 7,500. So we add 7,500 and you get a figure of 2,300. We subtract 2,300. 2,300. So 55,000 minus 55, 1, 2, 3. We get a figure of 34,700. We get a figure of 34,700 as the net book value. 34,700 as the net book value. And then we go to furniture and fittings. Furniture and fittings, right in full, 9,600. 9,600. We get the depreciation at the beginning of the year, which is listed in the trial balance, which is 9,600. The depreciation listed in the trial balance at the beginning of the year, 9,600 plus the charge for the year. Furniture and fittings, 2540 plus 2540 plus 2540. We get a figure of 12,140. 12,140. 12,140 minus, it cannot be that way. It cannot be that way. Furniture and fittings cost. The cost from the trial balance is 35,000. From the trial balance, it is 35,000. This should be 35,000. 35,000. So 35,000. 1, 2, 3. Minus 12,140, we get 22,860. We get 22,860. Then you add all of them to get the tangible non-current assets. You add all of them. 56,250. 56,250 plus 34,700. 34,700 plus 22,860. 22,860. We get a figure of 113,810. We get a figure of not really. Let me see. Let me repeat again. 56,250. 56,250 plus 34,700. 34,700 plus 22,860. 22,860. We get a figure . Something is amiss here. Building has accumulated depreciation, because you are saying that building has an accumulated depreciation of 2250. 2250. At the beginning of the year, it had, from the trial balance, it had 18,000. 18, 1, 2, 3 from the trial balance for the building, plus the charge for the year 22,850. 2250. We get a figure of 2250. So this one is not 0. It is 2250. 2250. 56,250. 56,250 minus 2250. We get a figure of 36,000. This should be 36,000. So we add them plus 34,700. Plus 22,860, we get a figure of 93,560. 93,560. 93,560, they are the total tangible non-current assets. 93,560. So we add investments. From the trial balance, we have investment as a block figure, but additional information number 7. Additional information number 7 breaks them down into long-term and short-term. So we add long-term investment. Add long-term investments, which we say it is 12,000. From additional information number 7. Number 7 breaks down the investment to both long-term and short-term. So if we add 93,560, we add 12,000, We add 12 of 1, 2, 3. We get 105, 560. 105, 560. 105, 560 as total non-current assets. Total non-current assets. Total non-current assets. So we come to current assets. We come to current what? We come to current what?
Assets.
And we start with inventory. And we know our inventory. Our inventory we said is 15,160. 15,160. We say we come to accounts receivable. Accounts receivable. And we say we have a provision allowance for doubtful debts of 1428. So we get the accounts receivable. We get the accounts receivable in the trial balance, that is 7,500. Accounts receivable in the trial balance is 35,700. 35,700. 35,700 minus what has been provided for. Accounts allowance for doubtful debts 1428. 1428. 35,700. 35,700 minus 1428. 1428. We get a figure of 34,272. 34,272. 34,270 what? 2. From there, we don't have other debtors, but we have prepayments. We said we have prepayments. We have prepayments. We said we have prepayment amounting to 300. Inventory prepayment amounting to 300. Your prepayment amounting to 300. But we also have investment, which is a current asset. We also have investment, which is a current asset, as broken down in number 7. We have an investment, which is a current asset, a short-term investment amounting to 22,300. Amounting to 22,300. Investment amounting to 22 what?
300.
300. Do we have any bank? We actually have a bank overdraft, and we need to find out what this overdraft is. This overdraft is very important, that we get the total of the bank overdraft, because it is part of our current liabilities. If it is part of our current liabilities, 1680 plus 1680 plus 160 plus 300, giving us 2140. So we do not have bank. We do not have anything to do with the bank. So we add them. And we are saying we get 15,160 plus 34,272, 34,272 plus 300 plus 22,300. We get a figure of, let me repeat again, 15,160 plus 34,272, 34,272 plus 300 plus the investments, which we said is 22. Our investment is 22,500. It is 22,500. It is 22,500. It is 22,500 what? Plus 22,500. We get a figure of 72,232. 72,232. 72,232 is total current assets. Total current asset. Total current what?
Asset. So
we get total assets. We add the current and non-current plus 105, 560. 105, 560 We get 172,792. Total current assets here. Add total non-current assets. So total non-current asset here, 105,560. We get 177,792. 177,790 what? Our total assets get to 177,792. 177,792. Then we say financed by. Financed by. We say financed by. Say financed. Financed by. And we say equity and reserves. Equity and what?
Reserves.
Equity and reserves. Equity and liabilities. Equity and liabilities. Below there we say equity and reserves. Equity and reserves. And we start with ordinary share capital. We say that our ordinary share capital has a balance of 40,000. Please look at it. We are not going to the trial balance to get our ordinary share capital because we had adjusted ordinary share capital. The temptation is to dash to the trial balance, and there you will find the ordinary share capital with a balance of 20,000. But here we are saying the balance at the end of the year is 40,000. So we come here, we say ordinary share capital. It is 40,000. Then we have preference shares, 8% from the trial balance. 8% redeemable preference shares, 12,000. 8% preference shares, 12,000. Then we say we have share premium. We have share premium. This account, we say we have share premium of 6,000. We said we have share premium of what? 6,000. We have share premium of 6,000. Then, if you look at the trial balance, you ask yourself, do we have any other capital reserve? We have revaluation reserve. We have a revaluation reserve amounting to 3,400. Revaluation reserve 3,400. Revaluation reserve amounting to 3,400. Then we ask ourselves, did you transfer anything to general reserve? Did you transfer anything? We are told additional information. I don't think we transferred anything to revenue reserve or general reserve. We don't seem to have transferred anything. And therefore, we got to retained earnings. We got to retained what? Retained earnings. We got retained earnings. And we said our retained earnings is 57,762. 57,762. 57,762. So we add them up. We add them up. 40,000, that is 52,000. 52,123 plus 9,400 plus 57,762. 57,762, giving us a figure of 119,162. 119,162. That is total shareholders' funds. Total shareholders' what? Funds. Then we come to non-current liabilities. Non-current liabilities. And we have, from trial balance, 6% debentures. 6% what? Debentures. And the amount for the 6% debentures is 10,000. 10,000. Once again, if we are of help, I want to ask you kindly. If we are helping you, I want to ask you kindly, like, share, subscribe, and hit the notification bell so that when we load these videos, as many of them as we do daily basis, we will be notifying you. Also join us for our online classes. We do intensive revision. We cover syllabus. This one we have done for the last 16 years, and I can assure you we remain the best. So we move on to current assets. We move on to current what?
Assets.
Current liabilities. Current liabilities. And we know the first current liability is what? Bank overdraft. Bank overdraft. Our first current liability is the bank overdraft, and we say that our bank overdraft is 2140. Our bank overdraft, we said it is 21 what? We said our bank overdraft is 2140, so we capture it there, 2140. The other one is current accounts payable. It's accounts payable. You go to the trial balance. You go to the trial balance. And you look for the accounts payable. You look for our accounts payable. And you can see it is 17,770. Our accounts payable is 17,770. 17,7 what? 70. Then you look for the liabilities which we made adjustments for. You look for the liabilities which we made adjustments for, starting with the debenture payable. Starting with the debenture interest payable of 300. So you say interest payable we say it is 300. Then any other liability, we have rates payable 240. Rates payable 240. Rates payable 240. Preference dividends payable 480. Preference dividend payable 480. Ordinary dividends payable 4,000. Then we check if we have any other current liabilities. Yes, from the trial balance, which we never did adjustments. If there is any other current liabilities from the trial balance, which we never did adjustments, and you can see we have deferred tax. We have deferred what? Tax. We have deferred tax amounting to, we have deferred tax amounting to 5,200, which we are not very sure whether it was both current or non-current. But we can still put it under current liabilities, but it also could also fall under non-current liabilities. So if we say deferred tax of 5,200, I'm looking whether there is any other current liabilities I'm missing, and I'm not seeing any other. So if we add them together, 2140 plus 17,770 plus 300 plus 240 plus 480 plus 4,000 plus 5,200, we get a figure of 3,130 plus 10,123 plus 119,162 Yes, we have not added, here we have not added tax. Tax is 18,500. Tax payable, 18,500. 18,500. Let's add them up now. 2140 plus 17,770 plus 300 plus 240 plus 480 plus 4,000, 1, 2, 3, plus 5,200 plus 18,500, we get a figure of 48,630. 48,630. 48,630. If you add that to the total current, non-current liabilities of 10,000 plus 10, 1, 2, 3, plus 119, 162, 119, 162, you get a total figure of 177, 792. You get a total figure of 177, 792. If you add all this, if you add 48,630, you add 10, you add 119, 162, you get 177, 792, which is equal to the total assets. And that makes the whole thing to balance. And that's the way we were required to do that question. Once again, I want to urge you, like, share, subscribe, and join our online classes. We will be doing, and we do very, very many of such questions. Thank you very much.